we've had in the prior two gold bull markets over the last 50 years, both of which were eightfold advances, bear low to bull high dollars. Okay, because we started from 1,050. And that merely replicates the dimension of the prior two big bull markets in the last 50 years. But if you look at the action in the last year, or even the last several quarters of each of those bull surges, the one that peaked in 1980, $850 gold, silver is $50. Or look at the one in 2011. Much of the percent gain occurred in the final year, or actually in the final several quarters. And it's at that point silver went berserk.
Please watch, share, and like this video. Subscribe to the channel and turn on the notifications bell for instant alerts. We appreciate the support and hope you enjoy the video. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pin comment. Stay ahead of the curve. Don't miss out.
Or momentum trend metrics. Price, meanwhile, on the S&P and NASDAQ, you could say, well, it's having a drop, no big deal. It's a correction, buying opportunity. But by our quarterly momentum trend metrics, which is a long-term metric, it doesn't say, oh, you're going to go down for 2 weeks. It says you're likely to go down for, a year or so, maybe more. We broke structure. We broke it in January, but NASDAQ stubbornly wouldn't. NASDAQ 100. It broke it about a month ago, above current levels. And I think what's going to lead to is a layered slab by slab decline, not necessarily a crash event, which means 30-35% in 2 weeks. Okay. But more like, 10-15%, then, oh boy, it's a buying opportunity, then congestion, then another 10-15, et cetera. But during that process, money goes elsewhere. If you go back through history and study 29 through 32, or study the mid-70s to the 74 collapse in the stock market, and the wasteland that followed, the 2000 dot-com top, the 2007 top. And look what gold did during that time. Up, okay? So did T-bonds, by the way. There's potential for T-bonds to try to tag along with gold here briefly. Not a place to be long-term, for sure. But the issue is not whether the gold and the gold stocks and silver are going to advance. The issue is now, with that breakage in the stock market and the flow of money elsewhere to safe places, that gold and silver and the miners are going to go up more aggressively. Which what we've seen since March of last year is a layered, confusing advance where many people 3 or 4 times got scared out of the market, the gold and silver market, and it didn't mean anything. And again, recently they sold the $35 level of silver. Now we get back to 35 again a month ago. Now we're back to above 35. Okay. So they keep selling these levels and it stops it for a while. Same with gold. I think we're about to enter acceleration. And I think the acceleration is going to be most notable in silver and in the gold and silver miners, with Mama Gold sort of leading the way, but not performance-wise anymore, percent-wise. Trend, yes. But the swing to the upside in silver and the gold miners now will be slingshot-like, where they get out in front of gold in performance terms. And it's the better place to be, I think, this year. We've had in the prior two gold bull markets over the last 50 years, both of which were eightfold advances, bear low to bull high. Right. We do an eightfold advance, gold is going to be $9,000, okay, because we started from 1,050. And that merely replicates the dimension of the prior two big bull markets in the last 50 years. But if you look at the action in the last year, or even the last several quarters of each of those bull surges, the one that peaked in 1980, $850 gold, silver is $50. Or look at the one in 2011. Much of the percent gain occurred in the final year, or actually in the final several quarters. And it's at that point silver went berserk in relation to gold. We've got reasons to believe, this is not gut level or, just looking back at the past. There's technical reasons when we assess the performance trend of miners versus gold and the performance trend of silver versus gold and plot it technically as a spread. And then run momentum studies of it. It says to us that the pullback we saw in performance since that surge in mid-2020, when silver and the miners beat gold handily during that big boom, But in the years since, they've retreated on a relative basis. Silver's more or less gone sideways, actually. It has not lost ground to gold, but it hasn't outperformed. And the miners have actually lost performance. Those charts tell us that we're in the upturn phase now, out of that period where those categories of the monetary metals underperform gold. They're now about to shift to outperform. So it's a technical assessment. And I think that's will be coincident with an acceleration in price of the entire complex. Not a target. It's not a target. It's just simply stating prior to realities. And you, as an investor, can decide whether he thinks the reality today is similar to those, or is it far more dramatic? And I think it's going to be more dramatic, and not just here in the U.S., but globally, in terms of especially government debt crisis. Right now, we're watching commercial real estate for a debt crisis, not mortgages, but commercial real estate, and hence, therefore, the financial sector. I know everybody's looking at NVIDIA like that's the be all and end all. And no, it's not. Look elsewhere. But when that stuff hits the fan, the panic mode and the emotion involved in markets will shift dramatically. And I think it's already beginning. Miners, specific ones. I've got a handful of them, and I'm going to expand it. So at this point, at this juncture where I think we're about to accelerate, my emphasis is not to be fully invested, because I am, but to shift the investment around and lessen my straight bullion position in gold and move it over more to a silver bullion or a double silver bullion position, and or into the silver miners, because I think the geometry there could be jaw dropping in the miners.
Or torque, yeah.
Because historically they are so beat up historically compared to the price of gold. Like XAU index is an example. It's been around since the 1980s.
Mm-hmm.
It used to trade as a relative percent of the price of gold in a range where you divide XAU price into gold price, in a range from the 1980s, 1990s through 2008, okay, so 20, 30 years, in a range that had a low end 17.5% and an upper end at 35%. So let's call the middle, let's say 25%. So XAU would do this over that 30-year period, but generally around 25% of the price of gold. It collapsed to 4% of the price of gold during the 2015 bear low, when it bottomed coincident with gold in net price. Right now, it's about 5.5%, a little higher probably. It's been in a 10-year wide range on the spread, not up there in the 17 to 30% level, but in the 4% low, basically 5 to 8% doing this for 10 years, meaning holding its value versus gold, but at extremely low relative levels, historically speaking. If you look at that chart, and we've sent it out in our reports, and look at the bottom end of that 30-year period, where it was 17.5 to 35%, and draw a line through all those lows that prevailed for several decades. That means you break this spread out, technically speaking, you could run up and bump your head on the bottom side of that multi-decade range, which is technical resistance, right? Okay, boom, the bottom of the old, what had been a floor, and you could stop there if you want. That's a tripling plus of the current value of the miners relative to gold. And we're seeing emergent breakout now, this month, on this month, that suggests we're coming out of this base, of this performance base, which is again very subdued. The top end is only 8%. And 17.5 used to be the bottom end. So decades ago. So we could get an extreme explosion out of the gold and silver miners. And the reason being coincident with the breakage in the stock market. A lot of investors don't want to go out and buy silver bullion or futures or things like that, or buy leverage call positions. They just want to buy miners. Some of these miners, after all, have pretty good dividends, okay? Some of the biggies. And so they'll move the stock category, most of the stock categories, which will go south, and move into the categories which are going south. The one of which will stand out is the gold and silver miners. And I've used the wet bar of soap analogy. Everybody's grabbing for the wet bar of soap, and it shoots up because it's a tiny, tiny little sector, dollar-wise. And even a small amount of money moves over, it could be a panic explosion.
Michael Oliver's analysis makes one thing clear. The precious metals market is standing on the edge of a massive breakout, and the biggest gains may not come from gold itself, but from silver and mining stocks. History tells us miners have been undervalued relative to gold for over a decade, lingering at levels far below their historical norms. But now, the technical indicators are flashing green. A breakout from this long-term base could send miners soaring, not just by a modest percentage, but by multiples, tripling or more in relation to gold's price. And with silver's historical tendency to outperform in the final stages of a gold bull market, we may be looking at an explosive opportunity. This isn't just speculation. It's a fundamental shift in how capital moves. When financial instability shakes confidence in traditional markets, investors don't always rush to buy bullion or futures. Instead, they look for leveraged ways to benefit from gold and silver's rise, and mining stocks provide that gateway. With even a fraction of capital rotation into this historically small sector, the result could be a rapid, panic-driven surge, unlike anything we've seen in years. So, what does this mean for you? If you've been watching the precious metals market from the sidelines, now is the time to pay close attention.